So why would I go and buy an asset like that and borrow money from a bank at 7% or even 6.5%, right? Why wouldn't I just go raise all the money I need from investors and go buy the property free and clear?
All right, welcome everybody. Mason, how's it going back east?
Oh, back east is an overstatement for this Cali boy here. It's going great, man. Business is at a really interesting time. It feels like there's more opportunity than there's ever been in the land business at a greater level and a higher level than I've seen since starting. But man, the conversation today got me hyped.
Yeah, this was so exciting. I'll pass the mic to you to do the intro, but we have Matt Faircloth on, and I was listening to Matt Faircloth in 2017 before I'd even bought my first property. I think I heard him on Bigger Pockets or one of the other shows. And so Mason and I met him in Philadelphia when we were out east a couple months ago and became, friends. And so now he's on the show. So Mason, you want to take that and run with it?
Yeah. And just like you, Dan, I'd been listening to Matt for years. I read his book and getting to meet him in person. Fantastic guy, just great person. But Matt's been a full-time investor for 15 years now. And in that time, he has successfully completed projects involving dozens of fix and flips, office buildings, single-family homes, and apartment buildings. He's amassed a portfolio of nearly 2,000 units and raised tens of millions of equity for these real estate projects in both debt and equity positions for these deals from passive investors. Matt is also the author of Raising Private Capital, How to Build Your Real Estate Empire with Other People's Money, published by Bigger Pockets, which has sold over 50,000 copies. And he is the host of the Best Ever Real Estate podcast, which is going to be premiering next month or potentially this month, whenever this episode comes out. So let's bring Matt in.
Welcome to the show.
Dan and Mason, thanks, man. Good to be here with you guys today.
Yeah, we're excited to have you. It was fun meeting you at your meetup in Philadelphia. Getting to kind of do a deep dive into your business. So let's get right into it. Mason and I have talked a lot about this. Of course, this is on the public consciousness within the world of real estate. There's a lot of fear in the commercial side of the business because of what's going on with debt coming due and having to refi at much higher rates. And so with your portfolio of apartments, and I know you have experience with office as well, what are you seeing personally? Is it as bad as everyone's saying? And then kind of as a corollary to that, how are you adapting your own business to move forward profitably into the future?
What's interesting is that, I think people were expecting it to get really bad, like blood in the street. Most people you talk to expect to see blood in the streets, right? Everybody borrowing money at 3-4%, and then all of a sudden debt now costs 6-7%. Well, holy crap, that's going to just throw the whole carousel, into a tailspin, right? We haven't seen that happen yet. And I don't know if it will or not. When we went into this, cycle, this lovely place that we're in now, when we went into it, I looked at the tea leaves and I said, okay, not everybody's debt's coming due. In the next 5 to 10 years, it certainly will. But I got properties right now at I got one that's got 3.2% interest on it. And that debt comes due in 3.5 years. Here's the deal, guys. I'm not thinking about that debt right now. Why? Why bother I might sell it subject to, maybe I'll do that. But it's not, there are many people out there, let's say even a high percentage of property owners are not in a situation where they need to do something right now. So you're taking 80, 85% of ownership off the table. Although there's trillions coming due, there's a lot more in trillions that's not coming due. Let's face that, right? That's number one. But the media would have you believe, the Chicken Little style, the sky is going to fall and everybody, and this whole thing is going to fall apart and it's all a house of cards, right? I think most people believe that, and we've been spending the last couple of years, kind of literally the last couple of years, waiting on the other shoe to drop, So that's why I think a lot of people are sitting around waiting, a lot of dry powder, a lot of people with money waiting on things to change, right? That's kind of a dangerous place to be because things are currently changing every day. But the change that they thought was going to happen hasn't happened yet, which is the bottom falling out. And I don't know if it will. What I have seen happen is there's two things. Number one, there really is real distress, but it's not public. It's either going onto the market as what I call distress in disguise, which is guy bought a property 2 years ago on bridge debt, and it's up on the market for sale, and he clearly just put a new coat of paint on it and is trying to sell it for double what they paid for it, hoping people don't figure them out, right? I'm seeing that. And I'm seeing also some real distress. But the real distress, I think, is working its way out in a lot of ways with banks and everything like that. So I think that a lot of these banks don't want another 2008, 2009 to happen. And so they're doing workouts with their borrowers. That said, above all that, above like the blood in the streets prediction, that's the answer there. Is it's going on the market quietly, or these folks are just doing workouts or just doing capital calls is what it is. The other side of it is we're seeing over the last 2 months, our company has seen a lot more properties come onto the market, at today's cap rates, not at a 4 cap anymore. I'm seeing 6 and 7% cap rates, okay. I can play with that. I can at least begin the conversation that way. So we're starting to see more and more deal flow of properties that are priced at least realistically. And I think we needed that 6 months shakeout for brokers to get that bucket of cold water on them. And that I'm also, and the last thing that I'm seeing is we made an offer on a property in North Carolina. We were like third best. We ended up finding out that property did sell, but the guy that won the bid, that won the property, ended up doing a drastic retrade when they started auditing the financials and digging in. And the property actually traded for a little bit less than what our offer was. It's not that the seller's already bound, right? Not that they're bound to sell at a retrade, but you're already dancing, you're already down the road. You might as well complete and everything like that. So we're seeing or hearing of more and more retrades these days. So that's an interesting little side note that a lot of times properties are going down for X and selling at X minus 10%.
Yeah. There's a lot there to unpack, but I think one of the ironies of this whole thing is, has there ever been a massive asset bubble or crash economically where everybody was expecting it? And so that's kind of like I said, the irony where exactly because everybody is expecting a problem, banks, private lenders and operators were all preparing for this for years and doing everything they could to try and mitigate against, the balloons that are coming. And so, if there is some sort of crash, I doubt it will be what everyone's expecting.
You sat me down 10 years ago and said, hey, listen, man, interest rates are going to be 6-7%. The stock, the Dow is going to be trading above 40,000, and then keep going on today's economic factors. I mean, these things are all not things that are plausible. Or even the stock market would have a 15-year run, a 15-year bull market, right, on the stock market. Interesting. And again, you said the markets never do what you think it's going to do, and I think that's maybe the way you should play is that, okay, what's the least probable thing that I think is going to happen right now? Maybe like multifamily keeps going up or real estate keeps going up in value. That's probably the least likely thing that nobody thinks is going to happen. So maybe that's what really happens. Who knows?
Yeah. That's the way it works, and it's the way it's always been.
Yeah.
Quick question on one of your points, Matt, was there's trillions and trillions coming due in the commercial loan space. Isn't there always trillions and trillions coming due? Because commercial loans balloon in anywhere from 3 to 7 years. So why do you feel, is that the way it's always been in terms of the fear-mongering articles that are out there saying, hey, all of this debt is coming due? And then for you as an operator, how do you potentially capitalize on what the media is saying about the market?
Well, you can throw that article into the broker's face and just say, hey, listen, look at how much is coming due. Or we've used it, obviously, to get investors' interest and everything like that. The reason why that's a significant fact is how much debt's coming due. It has nothing to do with how much is coming due. Because you're right. Now I'll give you a yeah, but, right? The reason why there's that much debt coming due, yes, there is a lot coming due at any given time. A lot of debt traded. A lot of people either refinanced or bought property 5 to 7 years ago because it was a really hot market and debt was super cheap back then. Money was, 2-3%, right? And so arguably a lot of debt transactions happened 5 to 7 years ago, which then automatically means that that debt does come due. So maybe it's a 10% bubble, right? 10, 15% bubble, but no more than it normally would be above that, right? The reason why it's significant is because the debt today is like double the cost of what debt was 5 to 7 years ago. That's why it's an interesting conversation. But I do believe a lot of that debt's going to get worked out. A lot of those buyers were smart enough. A lot of that debt was amortizing. Yeah, sure. Some of it was short-term bridge. Some of it was floating rate in that. But a lot of that debt might have been amortized debt to the point where you can just refi back at what your original debt amount was, and maybe you'll be okay. Maybe you just don't be greedy when you go to refinance, So a lot of folks are going to live another day. The data that I've used is really just a matter of keeping our ear to the ground and looking for specific opportunities and literally trying to find that needle in a haystack, because it doesn't mean blood in the streets. It means potentially new opportunities, but not guaranteed.
Yeah. You mentioned buyers being smart on these deals. How do you as a buyer, how are you smart? Tell us how smart you are, Matt, in these deals, and how you
I don't know, man.
How you do your cap stack to avoid and mitigate risk whenever you're doing these deals, whether interest is at 2 or 3% or 7 or 8%.
I think a lot of me, but I don't know. I wouldn't go here chatting about how smart I am or whatever, because we make mistakes all the time, don't we? But the way that we're working our way through that is we are, today we're not doing floating rate deals. Hey, shocker, right? But we did, and I got floating rate deals right now, and the way that we're mitigating those is we bought multiple rate caps that are pushing that are keeping us in the money with the debt for now and allowing us to, hold on for at least another year. And that while we continue to do what we do and push NOI and everything like that. What's been working in our favor is rents in most markets, although they're not up 10, 15, 20%, they're still up, 3 to 5%. And that. So it's become easier with a higher revenue market to drive NOI. And that's like the thing, people don't talk about very much. In addition, you got headwinds that it's also tough to keep expenses down with insurance being up 20, 30%, and everything like that too. So you got to kind of like really mitigate a lot of different things and know what really drives property value, and that's maybe how we're smart, is we're doing our best to keep NOI increasing by increasing revenue and decreasing expenses, right? While we also give ourselves enough time to allow things that are, NOI is what I can control, right? The cap rates and interest rates are things I cannot control. And so what I'm doing is I'm buying myself time to drive things I can control while I allow things I can't control to come back down to earth, like interest rates, So maybe that sounds smart. I don't know. You tell me.
Sounds very smart.
It really sounds like you're sticking to the basics, which tend to be the solutions, just doing that over the course of decades and not getting bored and not getting distracted oftentimes.
This business is supposed to be boring, but it's normally not. Again, normally there's a little bit of whack-a-mole going on. There's always a minor, a major fire to put out. People tell you that real estate, if run properly, actually is fairly boring. Looking forward to those days.
Yeah, I had a bit of a fire yesterday. Maybe we'll have to do a podcast sometime about just crazy shit that happens all the time in real estate. It would be a fun title, Craziest Stories.
We should do a Halloween episode. We'll do like a scary stories episode of like just scare like kids off show, right?
Oh, got great stories there.
We'll talk lots of people out of investing in real estate.
Perfect. It's a win-win for us. Anyways. So given all that, Matt, given the environment, given what you're doing, you mentioned making offers. How are you focusing both, as far geographically, demographically, and continuing to make offers and buy new units, given rising insurance, rising expenses in general, softening rent hikes? How do you approach buying today?
We used to buy as a company 70s vintage value add. Because that's where I grew up in real estate, so to speak. That was my classroom. I am a student of Trenton, New Jersey, of all places. That's where I first got started. And everything in Trenton. I mean, Trenton, stuff in Trenton was built like, turn of the century, turn of the 1900th century, not the 2000th century. So I learned everything about dealing with old vintage properties. So we knew as a company, as I grew into the space, how to deal with old stuff, like name the list: galvanized pipe, aluminum wiring. Forget about aluminum wiring. How about knob and tube wiring? I've seen all that. Lead-based paint, all of it, And so we knew how to run older vintage assets. And so we made a name for ourselves in doing C-class value add, 70s vintage properties or whatnot. Because 70s vintage assets became kind of where people ran for yield over the last 5 years, those properties got pumped up a lot and started trading at way lower cap rates than they should have, given what you're buying. And correlate that with insurance companies getting wise to it and realizing that a 70s vintage property is way more likely to have a fire because it's not going to have sprinklers, it's not going to have all these modern amenities, it's probably got old wiring and all that jazz. So insurance companies were cranking down heavy and even getting out of the space on C-class and 70s and even 80s vintage stuff. So to pivot with the new economy, our company's no longer looking at assets like that. We have quite a few of them already, so we're good. It's not like we're getting out of those kinds of things. But to diversify, we're looking at newer stuff. My company's building 3 apartment buildings right now, coming out of the ground. So that's we've gotten into that. I'd rather control the entire capital stack and control the future of the property from the time that a hole gets dug in the ground to the time that a tenant, moves into the unit for the first time. And that's something we've been able to do. So that's another pivot we're doing. And we're also just looking at newer vintage 80s, 90s, and 2000s. And we're under contract right now on a property that was built a year ago. The only reason that deal works is because we've got a 1031 exchange buyer. He's our equity with us. And so that's the other angle that we're doing, is get a little more creative on where the equity comes from. We're certainly raising plenty of new equity from existing and new investors that just want a great return. Those folks are in stuff like new builds and other existing assets, but we're also buying interesting stuff that makes sense to those that are trading up with house money, so to speak. And in that, like 1031s and that. So we're doing a tick with this person coming in that doesn't want to deal with the day-to-day management. We will. So we're buying a brand new vintage asset with them. And that mitigates a lot of different things. Debt's very cheap on a property, cheaper on a new build property like that. Insurance is cheap. Maintenance is low, everything like that. So it's a good deal if you got enough equity, an equity that's willing to be patient, like it would be for a 1031. So those, in no particular order, are some of the things that we're doing to continue to grow and stay relevant in this changing economy.
Yeah, absolutely. On a very small scale, I can relate to that. I'm doing some new build duplexes that I'm just keeping because after having done this for a number of years, I want buildings that are younger than me, and I can place tenants with 700 plus credit scores at the minimum. And so I'm so done with older properties, so I can relate to that. So to that end, on these new builds or these very, very new vintage properties, are you structuring them at all differently, where the debt is set up or equity, however you're doing it, to hold it in perpetuity? Or are these still short-term where you're flipping them? What does that look like?
No, we're structuring everything we do these days because, again, I don't know, right? Hey, I'm kind of done trying to predict the future. And that's what a lot of folks did in the last 5 years or so. And you underwrite a deal in, let's say, think about those folks, including us, that underwrote a deal in 2018 saying, okay, we're going to unload it in 5 years. And we're going to sell it at a 4 cap when interest rates are, 3.5%, because that's what interest rates are now in 2018. So we'll underwrite it to being today's interest rates. I'm kind of done predicting the future. And so what we're doing now is we're just doing deals that cash flow today, or that will cash flow as soon as the paint's drying, so to speak. And then I'll hold them until we don't, right? Like we're building a new one, a brand new one out in the Minnesota market. And it's Minneapolis, Minnesota, right? It's in that part of the world, and there is no exit designed into the system. There is the exit is when we do, right? This is a brand new property, right? So why don't I just hold it for a minute, So we're just doing deals that cash flow today. The only other thing that I would say, Dan, is that we're looking at models. I'll give you some inside baseball. Okay, we're able to raise a reasonable amount of capital. Why would I go and borrow money on a small asset, like let's say like a 20 unit or something like that? That's a deal we're looking at right now. We're also looking at a 14 unit. We're looking at small stuff. It's fine. They're good assets, newer construction stuff. So why would I go and buy an asset like that and borrow money from a bank at 7% or even 6.5%, right? Why wouldn't I just go raise all the money I need from investors and go buy the property free and clear? And that's a strategy we've looked at, because if I got to pay a bank 6.5%, why wouldn't I structure it and just literally pay that exact same interest rate to my investors? That's the pref they want to see. 6.5%, somewhere in there. And why wouldn't I do that? And then when rates come down into the even 5% range, 5.5%, if they drop a full point, then I could refi that property, borrow that money from a more cheaper interest rate from a bank, return a bunch of investor capital. Investors are happy because they get a bunch of the capital back. They get their chips off the table, so to speak. It's going to throw their cash on cash and exposed capital through the roof, up their IRR long term. You're right. And that's a model we're looking at for a new and old, not old vintage properties, but for older vintage properties. If the debt is within the realm of possibility for us to be able to raise, we have a long conversations with ourselves about raising that debt, raising that first position of the capital stack. Let's say some call it debt, raising that first position versus borrowing it.
That's great. And I want to dive into raising private money, but just want to ask one more operational question first. So we've talked about it a little bit. Of general revenue is up, through rent rates over the past handful of years. Cost of insurance is up because of natural disasters and insurance companies wanting to make more money or whatever their justification is. Debt is more expensive. You mentioned, improving your NOI and what are the expenses that you're actually able to effectively reduce, and how do you go about reducing them?
Okay. A couple of different ways. Utilities are an easy reduction because you can buy, especially you buying a 70s vintage asset, you likely don't have LED lights. You likely don't have low flow toilets. You likely don't have, low flow shower heads and low flow sink fixtures and that kind of stuff. So you can make a easy utility play. A lot of things I just listed will drop your utility bills in the neighborhood of 30% or more, right? More efficient insulation. You want to get, that's going to cost you, but you can get into that as well. We've looked at utility upgrade packages on our assets in the realm of like $300 to $400 a unit. And that includes low flow toilets, low flow sink fixtures, and LED lights. Now, yes, some interior lighting bills get paid by your tenants. You could look at it being nice and and the tenants end up just saving more money and they're going to want to stay there longer because the utility bills are less. But there's also incentives from agencies like Fannie Mae, Freddie Mac for doing those kinds of things, for doing low energy packs. And most properties do pay the water bill. You could pass that along to you could do a low utility package, a low water package usage for and then pass the bill on to the tenants. And that so utility is probably the lowest hanging fruit. There's other attacks you can do. Obviously, more complex things like appealing your real estate taxes or making sure you're properly valued. I saw a report the other day that because property values are down, upward in the realm of 5 to 10%, more and more people are appealing their real estate tax valuations. If they got valued any time between 2000 and let's say 18 and 2013 or 2023, you should consider appealing your property tax values because the town's probably pushing you at yesterday's prices, and that's not fair. So you should consider that. Other angles that we have taken are sharing of maintenance expenses. We do, and again, we've got a complex company. We own the property management company that runs our assets. So we'll do staff shares. We have rotating maintenance technicians that one day may be working at one property and the next day may be working at another property. So it enables us to keep our maintenance staff working and, adding value as they go, turning vacant units, those kinds of things. And they're not just, sitting around waiting on a work order to come in sometimes. if there's nothing happening at property A, they can run down the road to property B that we also own and do work there too. And so property A is not paying that labor bill, so that's been able to lower expenses as well. I'm just off the top of my head. Those are just some off the cuff ideas on how to reduce expenses overall on properties. One more thing, material shares. That if you've got a couple of properties, in a certain area, and we don't, like, some guys get crazy with, they'll rent like a storage unit or buy a little warehouse or something like that to put like 98 boards of sheetrock and 35 washer dryers that they found on sale. We tend to, I guess, just we're a little more scrappy, so we'll just do it in the basement of our properties. We'll take our properties and use those to store materials for all of our assets in a specific market. So we will do bulk material buy that we can get at a good discount. And we also standardize materials across the board. So you walk in one of our properties, you're going to see a refrigerator that is in all of our properties, and that's a good way long term to save on expenses as well, and just material purchases.
Yeah, that's all great. It's efficient processes with your labor, utility expense reduction, just more efficient kind of across the board. And it's something to think about for people doing new construction on apartment complexes, of build in some storage space, because having that stuff on hand can be effective too.
We didn't do this. The guy we bought a property from, he went and bought himself a sea container, which you can get, like, they're very affordable. And he found an empty part of one of the parking lot of one of his apartment complexes and just dropped a sea container there. And that we ended up not having to do that, but I was like, it's not a bad idea. Kind of out of the way, as long as it's not unsightly. And he filled the whole thing up full of all kinds of stuff that he needed for that particular asset. So whatever it takes, buying in bulk can save you a ton. And one more, way more complex, Mason, thing that we're looking into, it, I've done it yet, is things like getting really creative on insurance, because insurance has gone way up. So we're looking at things like captive insurance, which kind of sounds aggressive, doesn't it? But it's not. That's just a means of kind of being partially self-insured, to say it like in layman's terms. So we've looked at captive insurance or other type of insurance solutions, and also or just like a blanket insurance policy over all your properties. Easier said than done, but that is something that we've looked at as well.
That's great, and great insights on all of that. And that's a type of insurance that I haven't heard of, but will research more. But switching gears, Matt, to talk about raising private capital. I've read your book. We for those of you watching on YouTube, you can see the title of Matt's book, Raising Private Capital. Right there, beautiful. It's a fantastic book. It's a great point to start on. But let's talk a little higher level of, you mentioned kind of how you approach it on these smaller deals of just raising all the capital rather than getting debt service through a bank when rates are higher. How do you approach mitigating risk on these larger deals through the capital stack, and kind of what's your approach? Break it down: debt structuring, equity structuring.
Yeah.
The floor is yours.
Sure. We don't get too I've seen deals where, like, first position bank, second position mezz debt, third position pref equity, fourth position common equity, or maybe another equity stack in there too. We don't get all that complex when we do deals, and that we do typically do 2 share classes, which is like a class. We do class A, class B shares, and that enables us to borrow a little bit less money than that. And we've also looked at maybe getting a little more creative on those class A shares. Class A shares are typically shares that just make a flat rate of return, whatever that number is, whatever your deal can tolerate. And we also don't, air quote, print too many of those shares. Now, more aggressive firms will go and say, okay, if I need, I don't know, $7 million worth of equity, I'll go and create $4 million, like over 50% of these pref equity shares, because they're attractive, they pay day one, they're good cash flow pieces, a lot of people like them, and I'll put really aggressive interest rates on them, like 12%, something like that. And it's easy to attract investors to that. The problem is to your point, is that you end up subjecting yourself to a lot of monthly debt service. And we add in your current debt, and if you look at that first position equity in the stack, if you look at that as like soft debt, so to speak, then you're going to be paying a lot per month to maintain your carrying cost, right? So we tend to not create very much of those, payday one, and we also don't pay as much as some others do, as 12% or whatever, because I want to make sure people can get paid. Number one, I want to make sure investors are making something on the deal, especially if they're believing us enough to get into Class A shares on the deal. I want to make sure that they're getting cash flow. And that's number one. Number two, I'm okay having those Class B shares behind them that are, they're last in line, but because they're last on the line, they also get upside on the property. So if I can make, turn the wrenches the right way and make the property go up in value over a long period of time, those folks win the most. And they win the most because they're willing to wait the longest. And so I think that if you play time properly, and don't play sizzle marketing, like, 12% cash on cash return day one, these pref equity shares, whatever, that's sizzle. But it may not actually pan out. I'd rather have Class B shares that aren't performing very much at all, and not being afraid. Oh, one more thing, Mason, not being afraid to defer the pref, because there's plenty of assets we have right now we're not paying a pref on. It's accruing, it's adding up, and we know it's there. But we are not a firm that just goes and blindly, pays out pref to investors, because it's a great way to keep your investors in the dark. It just throw them out the 6-7% that you owe them on a quarterly basis, and send out vague monthly reports, and investors think everything's fine until all of a sudden until you run out of money and you have to do a cash call. I know other syndicators have had to do that. That's not us. We try to be way more transparent in our reports. And we're not afraid to not pay a distribution in exchange for keeping the company cash flush. So, the LLC that owns the property, that company, in exchange for keeping the company cash flush longer term than that. So those are some conservatisms we have baked into our pie.
Great.
Yeah, there's a lot there. If you're listening and you're raising money, go back and listen to that. A question I really wanted to ask, Matt, is if you've been doing this for years, and something Mason and I think about when we're raising money here, and of course we haven't been doing it as long, is making sure we pick and work with the right investors. The 80-20 rule tends to apply to everything, and so we've had many conversations about how we screen investors to make sure that we don't regret taking their money. So can you speak to that at all? Are there any red flags or experiences you had that have taught you, watch out for this, or if they do this sort of thing that might be problematic, or anything you want to add about just being cautious as to whose money you take?
Yeah, in today's day and age, we've systematized the investor interface with DeRosa to the point where I do talk to investors on a regular basis, but not as many as I used to. When I did used to speak to a lot of investors, the absolute largest red flag I would caution people of, and this is a rule that I broke and paid the price to deal with it, is dealing with investors that view their either knowledge or their importance in the deal to be more than yours, right? Meaning like they think that they're my partner, and being my investor is not the same, right? They want to come in and they want to, look inside, like they want to walk the asset. They want to be, nuts and bolts of the deal and everything like that. And they're going to want to slightly puppeteer lead a bit. And they'll say things like, what can I, like, what if I decide that we should raise rents, or what if I decide that we should sell, or whatever it is. They're not really viewing your role in the project to be equivalent to theirs, right? They really want you to be their employee. In that, and I've guided people and said, when I got wise to investors using certain language and stuff like that, to say, okay, you know what, you're probably better off. I get you're smart, it's great, and I get that you really want to control this thing. I get it. Why don't you go and buy yourself either a turnkey asset, go buy yourself a 4-unit from a turnkey provider, and then you can run the whole asset. You can sell when you want. You can raise rents when you want to. You can do everything that you want to do. Maybe working through a passive operator is not what you should do, because it's just some investors that don't understand the passive / active investment equation. As in raising private capital, I call the deal provider and the cash provider. They don't really respect the deal provider to the point where they should be passively investing. They want to be again, we're transparent. So we tell our investors what's going on. We make them aware of it. We certainly sometimes have solicited investors' opinions about things, but at the end of the day, they also need to be able to trust us as their operators to make the right decisions on their behalf. That's why it's passive investing, is that so they can put their money into a thing with an operator that they trust is going to make the right decisions when it comes time to make those decisions.
Yeah. So sounds like watching out for investors who don't actually want to be passive and who have big egos, and the combination of the two sounds like is the worst.
Yeah. I mean, you probably have seen it, right? And a lot of folks will see that as you grow into raising capital. You'll meet plenty of folks that, I mean, you can be kind about it. Is that you probably are better off being the driver of the ship, and maybe you don't want to fully let go of the steering wheel. And I as an operator, it's hard to scale that way with investors that want to have one hand on your steering wheel, you know?
So we see it happen a lot, whether it's the operator that's been using all their own capital in deals for a while, or someone that starts out using other people's money. But whenever you see an operator or a GP or whatever you want to call it in this scenario start raising private capital, what do you feel like is the biggest mistake they make, whether that's legally trying to do illegal stuff or just structuring of deals?
No, I could make you the list. I'll speed around this without and we can unpack any of them you like. Trying to do a joint venture instead of a syndication, like avoiding paying the legal fees that it would take to do a legal syndication. That's the biggest mistake I see people make. That's number one. Number two, trying to do a backdoor 506B, meaning like 506B is non-accredited investors as well, but trying to broach the 506B rules a little bit by 506B says you can take non-accredited investors. Got it. But it also says you can't solicit, right? So having people do really solicitations, saying things like, I'm not going to say his name, but he did a post on Facebook like, I'm looking for non-accredited investors. If you're not accredited, call me. I want to talk to you. I'm like, man, that's a solicitation right there. It says you can't. It's like you're like a paradox right there. It says you can't solicit if you're raising non-accrediteds, but you're soliciting looking for non-accrediteds, right? So that's probably. And I said this is a big operator I saw do that. So anyway, things like that. Those are the two largest mistakes that I see people make. And then the other side of it, guys, is people not really believing, like they're trying to buy like a 5-unit and that, which is fine. Good. God bless. I hope it makes them lots of money. But these people, they don't realize that the level of effort and maybe the level of sophistication in buying that 5-unit is just a little bit less than it would be to buy a 50-unit. Maybe not a 500-unit, but people that aren't shooting for their full capacity, even if they got to bring on somebody to help them raise the capital or get a little more creative on how the capital comes in, people that just aren't playing at the bubble of their capacity, they're playing way below what their real potential is. Those are perhaps the three mistakes I see people make the most when it comes to capital raising.
Oh yeah, and I think we all see it all the time. I'll see people attempting to raise money of like, dude, you're selling securities right there. Like that's it gets complex, and which is why hire an attorney. None of us are giving you guys legal advice right now. Hire an attorney. It's so much less expensive than when you will get sued by the SEC.
Yeah.
But on that, Matt, obviously you've raised a lot of money. You've written a book on raising money. When do you feel like something flipped and it became easier for you to raise money? It seems like you have no problem on these, what you're calling small, to some of us might be large, of 12 to 20 unit deals.
Yeah.
And you're like, oh, I can go raise that money like that.
It grew over time. I've always surprised myself of what we've been able to do. I mean, even like when I first did my deal where I raised like $500,000, I wasn't sure where it was going to come from. I was so proud of myself. And I needed to do this for a motivational, and I'm also dating myself because this is back in the day, Mason, when people would mail you a check. When that was the investment. They like literally mail a check to the office. I get a check written out to the company that we were raising for, DeRosa Capital 9 or whatever, for like $50K and that. So make a photocopy of the check, and I would put it on the wall of my office to like, you did that, you see? And before you know it, the wall was covered in photocopies of checks, right? So that was when I started to realize, okay, you know, I'm starting to be able to do this in that. But I mean, like, every deal that we've raised for, I was a little like, okay, how's this going to go? To the point now where we have got a team that helps us with it. They're not helps us with it. It works for our company, that are staff and that. So we've gotten more complex over time. So I'm way more confident now than I was, but when I was doing it myself and doing all the investor calls and doing all the webinars and, you know, breaking rocks in the hot sun and doing all the grinding and everything like that, I never stopped surprising myself, but also I kind of got into deals that I still felt like they were just on the edge of what was possible for us, and then I got into let's figure it out mode. That's how we've always done it. So even like 500K, like, you know, wow, that was a surprise. And then a little bit bigger than that, $1 million, you know, raised it. Well, that was a surprise, and a little bit bigger than that, right? So each time it's been a bit of a surprise as we've crossed those hurdles. And even now, you know, as we look at larger opportunities, it's still something that, you know, it hasn't stopped being hard or surprising. And the ability to raise equity has actually gotten a lot harder recently as investors have gotten a little more skittish the last couple of years with everything changing in the market too. So it's a constantly change. It's a constant moving target.
Yeah, no, that's useful for Mason and I to hear where we're at, both, you know, in our personal businesses and what we're doing together with Ground Up Partners of, you know, playing to your capacity. I like that. And there's definitely some self-awareness created there listening to there, man. So thank you for that.
It's tough to raise capital right now. I know y'all are in the middle of you guys are in the middle of some amazing stuff right now. You know, I mean, your timing sucks, you know, because, you know, it sucks that, and I'm raising, I have a fund too, right? But it stinks to raise capital right now because investors are so skittish. They read the same articles that you and I read. And just like you and I, they tend to believe them, like, oh, maybe I'll just sit and wait. And that's, it's hard to get equity off the shelf these days.
Well, and what's
kind of glad it's difficult. And I think Mason was going to say the same thing, because if we can do it right now, we can do it anytime. It's just like I was talking to somebody who wanted to become a realtor and said, oh, this is such a bad time. And I said, no, this is a great time, because it's really hard and a lot of your competition's falling off. So if you can make it work right now, you can make it work anytime. So I feel the same way about what.
Man, I see syndicators that used to syndicate thousands of units of apartment buildings, but for some reason or another, they're not talking about those anymore. Now they're syndicating Bitcoin. Swear to God. You know, right. I mean, you might even know what I'm talking about. This guy's out there syndicating Bitcoin right now, you know, crypto funds and stuff. And these are people they claim to have been syndicating thousands of units of multifamily not too long ago, right? But all of a sudden, they're not talking about that anymore. And then like now everybody's drinking the Cody Sanchez, you know, Kool-Aid and syndicating for buying businesses, right? And that's cool. I get it. And then I get that. But like, these are folks that were chasing equity for real estate. And so there's been a lot of exits. For people chasing with it, what maybe they believe to be easier money, easier solutions, easier applications of capital, and that. So that's just a sign that the market's changing with regards to what people are chasing equity to get into, and less people are doing real estate these days.
Yeah, and what's interesting is you have to have enough conversations with enough potential investors, and limiting to just accredited investors makes it a little easier in that fact, where we just got a capital commitment that, you know, we're getting the wire any day now from an investor that they're nervous about the stock market, and they're talking about inverted yield curves, and the market's been moving up for so long and all this other kind of stuff. And they're like, I want to put my money in land and development. And so it's funny having like nuanced conversations, whether it's the real estate people or the finance people. And this guy's a finance guy, like he's a very much so finance guy.
Yeah.
So it's the more conversations you have, the better. But I think, Matt, as we're wrapping up right at the end of the show, we want to give you some time to talk a little bit more about Best Ever.
Yeah, man. Well, I mean, as I know you guys are, you know, big raving fans as well. And I'm a fan of the Best Ever brand. I'm a fan of the Best Ever conference is the best conference that, you know, not to like, you know, Best Ever is a good name for the company because it's the best ever conference I've ever been to. And it's not because that they have the best fireworks show or the best rock band that plays the happy hour at the end of the event. It's because it's the best actual, real, authentic conference. with nobody selling any kind of bullshit from the back of the room. No frills or anything like that. It's just great people. I was at Best Ever Con this past year, and I was just and my company rented a booth because it's of value to do that at Best Ever. Other conferences, you pretty much just flush your money right on down the toilet and get to hang out with cool kids, and maybe you meet one or two people. But I was hanging at our booth at Best Ever Con, and I'd met all these great people, and one guy comes walking by. He's like, yeah, I'm a full-time passive. I've got 70 passive investments right now. I've got 1.5 million coming back in a private loan. Do you have anything I can place that into right now? Just matter of fact, like he was asking me where the restroom was and where to go get a cup of coffee, talking about he wanted to place 1.5 million and wanted to know what we had available. And I'm like, well, let's find that coffee machine. Let's sit and have a talk, right? So he and I sat down and figured out what we had available, right? And how I could help him, right? EverCon also is a great peer space in that. So there's lots of other industries, not just multifamily, not just land development like you guys are doing, not just self-storage. It's all of it, all commercial real estate applications. And the podcast is the longest running daily real estate podcast out there. And the other thing is that Joe Faircloth, the founder of Best Ever, is literally somebody that a lot of folks in the industry, including me, look up to, and that's because Joe is very little sizzle, a whole lot of steak. Guy walks the walk. He doesn't just talk about buying multifamily or whatever. He's got tens of thousands of units under management by his company that he owns along with his investors, right? And so for all the reasons, I look up to the brand. And I look up to the brand so much that Joe Faircloth wrote the foreword to the initial release of my book, Pace Morby, who I also look up to, wrote the foreword for when it did a V2. But Joe Faircloth's words are still in the book and that. So I look up to Joe and Pace as well. And so super, super excited to first announce, I announced it on Facebook. It was the first podcast I've ever said it on, that I'm going to be one of the new hosts of the Best Ever Show. And every Friday, starting in August of 2024, there will be Matt Faircloth shows. And so really, really pumped to be and the angle, guys, what we're going to be going after is how can operators like us, right? Sure, passives are allowed to listen to. Okay, so you don't have to turn the podcast off if you're a passive investor. But the target's going to be operators like the three of us that are looking to get to the next level, whatever that means, right? So whatever level up looks like for Mason and Dan and for me and for anybody else listening, we're going to be talking about ways that real operators that really smashed it did level up their game and what we can learn from them, but also go further. What technology is coming into the space that's going to completely change real estate investing, such as, I mentioned crypto, making fun of it, but really, how could crypto become involved in real estate acquisition? How can blockchain get involved? How can AI get involved? How can virtual assistants get involved in the application into real estate investing, that we as operators can reach the next level of our businesses? What vendors are out there that are really changing the space? And also maybe some healthy debates and everything like that with other hosts of the Best Ever Show that I'll hold in high regard to. So lots of cool stuff coming down the pipeline for the and just looking to carry the Best Ever legacy to the next level itself as a show. I just want to be a part of that, carrying that flag up the hill, so to speak. I'm honored. I'm blessed. And I'm super pumped to get the first episode recorded, which is tomorrow is the first recording.
Yeah, that's exciting. That's the best real estate investing advice ever show with now Matt Faircloth, which I have listened to for years. So,
me too.
Matt, I know we're running out of time. So if somebody wants to get in touch with you, potentially invest, where do they go to find you?
They can learn through us through our education vehicles that teach people how to level up their multifamily game. And they can also passively invest with us. They can just learn about us. Just come hang out on our website. It's a nice website. They can go to DeRosaGroup.com. You can read all kinds of blog articles out there as well. Lots of free content too at DeRosaGroup.com. That's where you learn all about us.
DeRosaGroup.com. You heard it here, guys. I know you're out of time, Matt, so we'll wrap up and maybe have a round two at some point. But guys, this is Dan Haberkost and Mason McDonald here with Matt.
I want to come back on your show. Here's what I want to do. I'm going to come back for a new show, and I want to have you take me to school on land. And we'll probably do that on the Best Ever show as well when I have you guys on as guests. But what you guys do is probably one of the most misunderstood real estate investment ventures out there. And I think that more people should understand how all real estate investments start on a plot of land. It was a plot of land at some point. Something cool got built on it, and now is an investment venture. But land is literally the foundational real estate investment. So I'd love to get, because and I'm not saying that just to promote you two. I'm saying it because I don't understand it. I want you guys to take me to school, okay? So,
oh yeah.
So that
we'll be able to talk dirt and all the basics, and talk about how blockchain can resolve title issues and get rid of title companies. And
can you carry the blockchain torch with me? Good. Okay, good.
I can have a conversation, but carry the torch is...
well, I don't know. You already know more than I do about it, right? So that's just something that I see it coming into the space, and I'd like to discuss it with someone that knows a little bit more than I do about it, so I can just sit and ask them lots of questions and say, tell me a story about blockchain and why is it important,
Oh, yeah. Oh, yeah.
All right.
Matt, this was incredible. It's Mason McDonald and Dan Haberkos with Matt Faircloth for the Big Picture Blueprint, signing off.
Woo!